Companies often invest in equity securities issued by other entities. Recall that one of the rights associated with owning equity is the right to influence management. In many companies, this right comes in the form of a right to vote for the board of directors, and the number of votes is in proportion to the number of shares owned. In this video, we provide an overview of equity investments and illustrate the methods used to account for investments that do not constitute a controlling interest in the issuing entity. That is, the investor does not own enough votes, usually 51%, to control the actions of the investee's managers. In general, investments in equity securities are classified into three categories. 1. Equity investments that result in the investing company having no influence in the decisions of the investee entity. 2. Investments in equity securities that result in the investing company having a significant influence on the decisions of the investee entity. And 3. Equity investments that result in the investing company having control over the decisions made by the investee entity. The first category, no influence, includes equity securities that represent an equity interest too small to exert any meaningful influence on the management of the investee company. As a guideline, U.S. GAAP considers investments of less than 20% of the equity to meet this criterion. The significant influence category includes equity investments large enough to exert influence, but not control, over the management of the investee company. The guidelines here are ownership of 20 to 50% of the equity. And the investee company is referred to as an affiliate company under U.S. GAAP or an associate company under IFRS. Also, it is not unusual for this category to include joint ventures, where two or more companies enter into a partnership designed to achieve a common goal. The third category, control, includes investments where the investing company, called the parent, controls the decisions made by the investee company, called the subsidiary. This category, where ownership is normally greater than 50% of the equity, includes mergers and acquisitions. Note, in the cases of equity investments across the three categories, the ownership percentage serves as guidelines, not rules. What is really important for proper categorization is the level of influence, which can be exerted in many ways in addition to the percentage of ownership, including, for example, board membership, customer-supplier dependence, and other factors. Each of the three different categories of investment requires a different method of counting. In the case of no influence equity investments, which appear on the balance sheet as either current, short-term, or non-current long-term assets, an accounting method based on the market value of the securities is used as long as market prices are readily available, as in the case of publicly traded securities. This method, which we discussed in video 36, values investments on the balance sheet at their current market prices and treats the two companies, investor and investee, as if they are completely independent. In the significant influence case, the equity investments are considered long-term assets on the balance sheet because the reason for the investment is rarely simply to purchase and sell the securities at a profit. Normally, there is a longer run, strategic reason for the investment, and an accounting method called the equity method is used. This method treats the two entities as if they have a common overlapping interest. Finally, equity investments that create control of a parent over a subsidiary are accounted for using the purchase method, which leads to consolidated financial statements that depict the entities as if the subsidiary is contained within the consolidation of the two entities. Walt Disney has a number of investments in the equity securities of other companies. In fact, they have investments in all three of the categories mentioned in the video you just watched. For example, Walt Disney owns 100% of the equity securities of ABC. Walt Disney owns 80% of the equity securities of ESPN. and 33% of the equity securities of Hulu. These investments and how they are accounted for are discussed in this particular video, which is one of 3 videos that comprise this course, and only about a total of an hour of video time. The course is dedicated to covering investments of all shapes and sizes, including not only equity investments, but investments in property, plant, equipment, and intangibles. Well-known companies featured in this video and this course include not only Disney, but 3M, a huge manufacturer that makes about many things that you use all the time. Post-it notes, for example. Also included, we're going to take a look at Yahoo, and Yahoo is a particularly interesting one. Yahoo had a major investment in one of the most successful companies in China ever called Alibaba. And that investment kept Yahoo floating for a while. But Yahoo continued to make equity investments in other companies that didn't turn out so well. And they led to Yahoo's demise, and ultimately to Verizon acquiring Yahoo and taking them over. We'll discuss those issues as well.